All right, everybody. Barry McGuire here. It's Thursday, October the 29th. It's live at 5. Barry McGuire's Creative Real Estate Education Group. And today we are going to chat about what's known as the Smith Maneuver. The Smith Maneuver. The Smith Maneuver is some financial magic that will help improve your investing profile, help you make debt deductible, really improve your access to funds. And we are delighted, absolutely delighted to have with us Robinson Smith, whose dad, Fraser Smith, figured out the Smith Maneuver some time ago. And of course, Robinson learned all about this at his father's knee. He's a presenter and an expert in the Smith Maneuver. So he's here to give us an explanation. We also have Shaune Impey, who is a member of our group and a mortgage broker, helping people all across the country. Shaune is a certified Smith Maneuver professional, which means that he's done a lot of work to make sure he understands exactly how the Smith Maneuver works. There's a lot of misinformation out there. Just want to say it, right at the beginning, that we don't want anybody listening to us tonight to get their information from the internet. We want you to listen to Robinson. We want you to talk to Shaune. We want you to listen and hear people who understand and are trained and who really do know what is going on with the Smith Maneuver. So with that, let's bring on Shaune and Robinson, and we can get this party started. And there they are.
Hello.
So there they are. So last night, everybody, Robinson and I were both on the Mogul Mastermind, which is on the last Wednesday of every month, with James Canal and the rest of the Mogul Real Estate Group in Edmonton and in Vancouver. I believe we were doing both provinces. And Robinson guested on the Mogul Mastermind last night and gave a really in-depth presentation on the Smith Maneuver. And so to avoid doing exactly the same thing tonight and maybe to dig a little bit deeper, we're going to just take less of a presentational approach to this. And we're going to, of course, we have to hear what the Smith Maneuver is, and Robinson will tell us about that. But then once Robinson gives us the details that he thinks we need, then we're going to dive into the practicalities of it, the pitfalls of it, the way you can really make it fly for you, and what you should do and what you shouldn't do. And we're going to try and be available to answer lots of questions, because this kind of a circumstance always generates lots of questions. So that's the setup for tonight. And with that, Robinson, I'm going to turn it over to you to give us your words on the Smith Maneuver, and we'll take it from there.
Yeah, thank you, Barry. It's a pleasure to be here. Hi to Donna. And I just want to say you're welcome, Barry. I did such a boring job last night that I really set you up for success coming after me at the Mogul event. And hello, Shaune.
Hello, Robinson.
I also understand that Wayne Hillier's in the house somewhere.
Wayne, good one, Robinson. Good one.
No matter what I put in this, it always tastes terrible.
It's got Wayne's mug. That was good. I like that.
Well, I guess let's just start off by I'll acknowledge that some of you viewers today may have been on the Mogul Mastermind presentation last night. Thanks for joining us again here on Barry and Donna's show. As Barry said, I'm not going to go through a presentation style here. I just want to basically give a little bit of history and describe how the Smith Maneuver works and why it works. And we'll lead off with that. Basically, my father, Fraser Smith, developed the Smith Maneuver in the mid-'80s. He always says he was in the shower when he came up with it. But he was a financial planner in Vancouver with a firm he co-founded called Granville West. And he was upset with the fact that the Americans could deduct the interest on their mortgage and we Canadian couldn't. He didn't think that was very fair. So So he read the Tax Act as one would in such a circumstance, and he put together a whole bunch of different pieces here, all revolving around the fact that if we borrow as Canadians to consume, we cannot deduct the interest on that borrowing. So it's relatively expensive borrowing. Plus, we're buying an asset, so a car or meals or whatever, which depreciate in value. So we're destroying our wealth by doing so. But if we borrow to invest with the reasonable expectation of generating income, we can deduct the interest. So it's relatively inexpensive. Plus, in order to get those deductions, we're necessarily buying assets which will increase in value over time. Stocks, bonds, mutual funds, investment, real estate, whatever the case may be, as long as there's a reasonable expectation of generating income. So he set to work, approached a number of the different banks. And back in the mid-'80s, the bank managers were like, what are you proposing here? This sounds irregular. No one's ever heard of this before, and banks don't deal with this type of stuff, so we're not interested. Well, he went to Larry Bell, who was the CEO of Van City at the time. And Larry picked up the phone on the first call and said, yeah, come on in. And they arranged a structure how this could operate. It was very clunky at the time, but it worked. Subsequently, pretty much all the major banks and lenders came up with what's required for the Smith Maneuver, which is a ReAdvanceable mortgage. And Shaune can talk a little bit more to that in a little bit because he's the mortgage broker, I'm not. But effectively, what the Smith Maneuver does is it allows you to access the equity in your home to put it to work as fast as you're creating it. We get a mortgage typically in Canada, and it's this one big expensive loan that we have to pay off over the course of 25 or 30 years. Every time we make a mortgage payment, we're increasing the amount of equity that we have in that house. So $100,000, $200,000, $300,000, $400,000 of equity in this house. And if we're not putting it to work by investing, it's earning us less than 0% due to inflation. It's just dead equity sitting in the house. And when the wealthy see this happening, they get a tear in their eye and they get shivers like, what are you doing? You've got $600,000 you could be putting to work for yourself. Why aren't you? Right? So what's required for the Smith Maneuver to happen, to function, is a ReAdvanceable mortgage. And effectively, we're able to re-access the equity that we're creating in our home in real time on a monthly basis with just that regular mortgage payment. We're making a mortgage payment whether we're doing the Smith Maneuver or not. We've got a house, we've got a mortgage, we've got to make a payment. But if we're doing the Smith Maneuver with only that mortgage payment coming out of your pocket on a monthly basis, whatever goes to reduce that non-deductible mortgage balance is available to be reborrowed and invested. And by doing so, by reborrowing to invest, not to consume, we're generating tax deductions, which lowers our tax bill, which we love. And because of this, most Canadians will get a tax refund form of cash at the end of the year. And if it's not a tax refund, it's a lower tax bill, say you're self-employed. But you're reducing your tax bill. And with this tax savings, money that otherwise you wouldn't see, you're able to make a prepayment against your mortgage at least once a year. And these tax refunds grow over time. So each year, those prepayments with the tax refund get bigger and bigger and bigger. And also, after you prepay that mortgage with that refund, you're able to reborrow it and get that invested as well. So we're investing on a monthly basis, and we're also investing on an annual basis by the amount of that refund. So not only are we reducing our tax bill, we are also eliminating that mortgage, which is relatively expensive, and much faster than what it says on the contract with the bank, 25 years, let's say, because we're prepaying at least once a year. So we're taking quite a few months, if not years, off this mortgage. Plus, we're getting invested now. And your listeners, the viewers today, are very clear on the fact that we need to do something to improve our wealth. And investing is how we do that. Your viewers will be actively or interested in investing in real estate, but they're borrowing to invest. Many people will have this conventional mortgage against their home, and then when the value of the house rises to a certain point and the value of the balance of that mortgage has come down a little bit, they can go back to the bank and say, hey, I've got some extra equity in my house. Give me a HELOC, slap it in second position against my existing mortgage, 50K, 100K, whatever it is. And then you go out and you pull that out and you can invest in whatever you want and generate tax deductions to a certain degree. But most of your viewers are taking that and putting it into investment real estate, down payment for a property. Fantastic. But if we're just getting a HELOC in second position against an existing mortgage balance, let's say it's for 100,000. As soon as we pull that 100K out and use it for a down payment on investment property, we borrowed all we can from that equity. And the next month and going forward, we are generating more and more equity because we're continuing to make a mortgage payment on that non-deductible side, but we can't get at it because that limit on that HELOC doesn't increase. Now we can get at it if we go back to the bank, get the house appraised again, and now the bank says, okay, we'll raise that limit from 100 to 120K. And I can pull out another 20K and go get it invested somewhere. But that's expensive, it's tedious, and you got to wait over time for this equity to be created in the house via the regular mortgage payments to be worth it. With the right type of mortgage, all we do is get the ReAdvanceable. And once we refinance our home, because we're in a mortgage that doesn't work for this, if we refinance our home into a ReAdvanceable mortgage, maybe we do have $100,000 that we can pull immediately, go get that rental property. But then going forward, $1,000 a month, that line of credit limit will increase $1,000 a month as that mortgage is coming down immediately, next month, the month after that. So now we can pull this $1,000 a month and invest it somewhere. And we're not going to pull $1,000 in the month for the month and buy another rental property, $1,000. Well, we can go into something we're comfortable with, stocks, bonds, mutual funds, ETFs, and it doesn't take long of accessing that equity on a monthly basis for those investments to grow to 50K or 75K, at which point, if it were ETFs or mutual funds, we can redeem that asset and go and buy our second piece of rental property if we want. So Shaune put it very well, better than I ever had the other day, maybe it was a few weeks ago on a presentation, describing exactly what I was just trying to describe. I think Shaune does a better job at it, but it's just immediately accessing this equity in your home and putting it to work.
I can jump in there for a second. I got a comment. So you mentioned about properties going up in value and be able to refinance and access your equity. There is circumstances where your house may drop a little bit in value and you can't go back and refinance. And if you go back there and they find out the house is worth less than what you paid for it and got your global limit or your maximum amount, you won't get anything out of it. So whereas with a Smith maneuver and getting your monthly deposits into your line of credit, you can always access that equity.
So the key, as I listen to this and have listened before, the key is to have the appropriate ReAdvanceable mortgage. I know there's tons and tons and tons of mortgage products out there. I'm sure that if we stumble along on our own, we can go and access what we think is the right product and be wrong. So it sounds like the first step is to make sure you have the right product.
Shaune?
That's correct. You got to have a ReAdvanceable mortgage with a HELOC that's going to increase as you pay down your mortgage. So, and there's, like Robinson said, there's most of the major banks have something like that, and a few of the monoline lenders also have something like that. It's important it's set up properly and the cash flows properly, so there's traceability for the deductible interest, and you always got to get your accountant involved there to make sure everything is, upfront. And I'm not an accountant or a lawyer. Leave that to Barry, and I leave my accounting to my accountant. So, but if you are making any kind of investment with this money out of your HELOC, you got to make sure that, number one, you don't mix business and pleasure and use it for anything that's consumable. And you have to make sure your accountant vets whatever you're investing in if it's something that might be a little bit outside of the box.
Yeah, I'll touch very on two things. One being the importance of using a mortgage broker like Shaune or any Smith Maneuver certified professional mortgage broker, rather than you may talk to a guy like Shaune, and Shaune will say, okay, based on your situation, this is the best ReAdvanceable mortgage for your situation, and you look at the rate, and then you go and you walk over to your bank that you've been doing business with all these years. What's your rate on your ReAdvanceable mortgage? Oh, we can beat that guy. We can beat that Impey guy by a couple of points. Well, guess what? That is going to, in all likelihood, going to cost you much more down the road because there are many nuances to this. Rate is really way down on the list of importance here. I do not care if I'm paying an extra $120 a month for my mortgage payment because I've got a slightly higher rate, if this strategy does enable me to improve my net worth by $300,000, $400,000, $500,000, $700,000, $800,000 over the course of the regular amortization of this mortgage. If I go and save that $120 a month, it's going to cost me quite likely considerably more down the road. There's prepayment allowances. You know, when we talk about some of the accelerators like the cash flow dam, I've got a rental property. Instead of rental income coming in and then to my bank account and then going directly out to make the mortgage payment on that rental property, cash flow dam accelerator says take that $3,000 monthly revenue from your renter, prepay your own mortgage, reborrow it, and then service the expenses on that rental property. You're borrowing to invest with a reasonable expectation of generating income. You're borrowing to invest in your business, that rental property. But if you've got a mortgage, a ReAdvanceable mortgage that you took on because it was the lowest rate around, well, now you find out that you're limited in your prepayment allowance, seriously limited in your prepayment allowance. And now you can't implement the cash flow dam. And now you've missed out on $700,000 of net worth improvement or something like that. And there's also payment, when you break your mortgage, you know, the best rate doesn't necessarily mean the best product.
Okay. So the thing that, something that pops up for me is that, just as a concrete example of a ReAdvanceable mortgage that wouldn't do the trick. Now, Shaune, you and I chatted about this. Am I recalling that the Manulife One mortgage, where you throw everything into one account and it all gets paid from there and it jumps up and down? Is that a ReAdvanceable mortgage that wouldn't do the trick here because you're mixing your consumable spending with your deductible spending?
You're mixing business and pleasure in that one there. So the way, my understanding of the way Manulife tells you to set it up is you just have one pot, paychecks and everything goes into it, and you pay for your car loan and your groceries and your utility bills and whatever you want out of the Manulife One revolving line of credit account there. So where do you distinguish what you're borrowing out of there to do for deductible interest on investments? So it can be worked, and if you set it up properly, but how you set it up is not the way Manulife One is outlined by Manulife. So Robinson, in his book and his course there, he outlines exactly how to set up a Manulife One so it can work. There's more management and paperwork, and I'm not sure what the right word is to look after this. It takes a lot more time and effort to look after a Manulife One that does some of the other ReAdvanceable products.
So there's a good example of a ReAdvanceable mortgage that without a whole bunch more administrative kerfuffle doesn't really work. So folks, that's why you talk to a guy like Shaune, who's a Smith Manoeuvre certified professional, because there are nuances and details to this that have to be done properly, or it's not gonna go for you. So eat that up enough.
And the ReAdvanceable mortgage that I have personally is a Manulife One. I find it functional for what I need to do. I've had the benefit of my assistant for many years, who deals with my former clients on an almost daily basis of how to manage that Manulife One for their Smith Manoeuvre. I had the benefit of her instructing me, so I don't find it terribly onerous. But there are nuances to every different type of ReAdvanceable out there. So you get an SMCP, a mortgage broker, and they'll understand that. They'll be able to figure out which one to go with.
The next thing that shows up is that it's time in the game that's important here. So people should think about getting this going early. Don't wait till you've got a ton of properties or more money. I mean, this sounds like something that is best set up tomorrow if one can possibly manage it.
Well, yeah, the truly wealthy among us, they can afford to pay the fancy tax lawyers and accountants to structure their personal finances to their best tax advantage, which we have a legal right to do as Canadians. So whether or not the truly wealthy understand that their mortgages are deductible and why, it doesn't really matter. But the typical Canadian can't afford these high-priced professionals, and so that's what the Smith Maneuver does. The Smith Maneuver brings this principle of tax deductibility, using debt appropriately, understanding debt, to the typical Canadian. Because, as I said, all we're doing is using our regular mortgage payment and restructuring how that flows. So now the typical average Canadian homeowner who's not truly wealthy can behave and act like the truly wealthy. They can do what the wealthy do, which is borrow to invest, use the equity in their assets to generate wealth.
Well, you know what? This has already generated a ton of questions. And so I'm going to suggest, subject to speaking to my producer, Donna, that we jump into some of these questions. So I'm going to look at them here. I'm looking in the chat. Wayne, are you going to put some of those Facebook questions up for us, Wayne, so we can all see them? Julie says, any accountants are more familiar with this in the Edmonton area?
I just signed an accountant into the program today, actually, from Calgary. Taxes are being done increasingly remotely these days, and it's more important to have someone who might not necessarily be in your neighborhood look after your taxes when you're implementing the Smith Maneuver. It might be well worth it to have someone who understands it, who might not, be in your city. So there are more and more professionals coming on as Smith Maneuver certified professionals. Soon we'll have an accountant in Calgary. But I've also got my accountant here in Victoria who takes cross-Canada referrals for Smith Maneuvers in areas that have an existing SMCP accountant. So we can handle cross-Canada taxes.
I support that, Robinson. I see more and more people accessing accounting services, not in the city and not even in the province where they live. So that is, I agree. That is certainly a trend in the accounting game. You don't have to have someone in your own town to help you on the accounting side of things. All right, so that's Julie's. Well, it's not really answering Julie's question. There's someone in the Edmonton area. So Julie, I don't know of anybody in the Edmonton area, but we're going to have someone in Calgary, and Fraser has someone in Victoria, and we'll make sure that information gets available so you can have a chat. All right, next question. Lung Yang Ing. I have a mortgage with Scotia, a step mortgage with Scotia. The issue is my Heloc credit doesn't increase as I pay down my mortgage. Oh. The advisor at the bank said I have to sign the form every time I want to increase my Heloc credit. Does it mean I got the wrong mortgage product? Well, if you had asked me that, I would have said, yeah, it should increase every time you pay down the non-deductible side. Shaune, that looks like one for you.
You got the wrong product, and I've talked to Ling Yin several times, and he told me about his mortgage. I said, see if you can get something done in the bank to get it to a ReAdvanceable and stuff like that. So obviously they're being a little obstinate with them. So yes, you have to have it set up from the beginning. So when I submit a mortgage application for people to Scotia, I outline exactly what it has to be. ReAdvanceable mortgage, always ask for the 20% prepayment clause because Scotia standard 15. We ask for what's called an automatic limit increase Heloc. It has to start at $10,000 at Scotia. So all that gets set up in advance, and that's how Scotia puts it together. So, before I knew about the Smith Maneuver, I was similar with Scotia. I had money in a Heloc that I got a one-time amount advanced to me, and I'm the same way, and I'm having trouble getting Scotia to convert it over as well. So it's basically you got to refinance into the right product. So.
That's new. That's new information for me because I just think of the Scotia Step product as a product. I didn't know that there were all of these things you could do, like asking for the bigger payout provision and have it be automatically moving. So the step has a number of steps in it. Sounds like.
Yeah.
Well, so it's kind of like you say, I want to buy a Honda Civic. And then all of a sudden, well, do you want a 4-door or 2-door or a 5-door, right? you have to know what variations of any particular mortgage exist and know what to ask for.
Yeah, good example.
STEP
All right.
stands for Scotia Total Equity Plan. So there's I think 11 different types of products you can get into your plan. So depending on how you're set up, there could be other ways to work around it. So, but the simplest is just set it up properly from the beginning.
So folks, I hope you can see that as a concrete example of why you need a broker who understands the Smith maneuver, so that if he's doing a Scotia step mortgage, he picks the right one of the 11 products, or make sure that they're put together the right way so you can really make the maneuver fly for you. Yeah. All right, next question. What have I got? If I just renewed a conventional mortgage with a Big Five bank, am I hooped, using the legal term, or am I hooped for the term, or can I switch to an advanceable product with the same lender? Shaune.
Well, that depends. If you have variable or fixed would be the first question. If you have a variable mortgage, you may be able to refinance at that same bank and maybe pay your 3 months penalty and get into something different. They may let you refinance and not charge you a penalty. So if you're in a fixed rate mortgage, again, the same thing. It really depends on the bank and their policies on your mortgage there. So, if you got something at a higher interest rate than today, they're not going to let you get away with not paying less interest over the term. So they may charge you a penalty, or they may do some kind of a blend and extend on a ReAdvanceable product. So it's really dependent on the bank. So,
it is the case that breaking a mortgage that doesn't work for the Smith maneuver to get into one that does can be worth the penalty, with the difference in rate, with the fact that if I break a mortgage, maybe the difference in rate and the savings over that 5-year term don't quite cover the shortfall. But then I have to look at, well, for the next 4.5 years, I don't get to invest $1,000 a month. So 4.5 years of $1,000 a month, that's a pretty pot at the end of the tunnel there. So is it worth taking a hit? By the numbers, the rates and stuff, it doesn't make sense, but you factor in the benefits that the Smith maneuver can generate you by starting now, not only getting invested, but also the reduction in your tax bill. Is it worth taking that hit?
Yeah. So just a sidebar on that is that when rates started to drop here substantially, back in the spring with the COVID and the Bank of Canada dropping the rate down to 0.25%, there was a massive move in the mortgage broker industry to get people out of a mortgage that they maybe signed a year or two ago at a high rate into something cheaper. And banks always work on the number of years you have left. They use that rate to set what the penalty is. So normally a 2-year rate or a 3-year rate was higher than the 5-year rate. So you'd get maybe you got a 0.3, 0.4 advantage by going to a 2-year rate, and then you could refinance at the 5-year rate. Well, banks got onto that pretty quick. So they dropped all their short-term rates to match their 5-year rates. So the penalty was, if they had discounts and other things on there, the rate that higher rate that you paid out and paid the penalty, often the interest over the balance of your mortgage would be quite a bit less than what you're saving. It could be a $20,000 penalty and you save $10,000 in interest. So people weren't interested in doing that. So it's a matter of finding out what your penalty is, how much you're going to save. And some of the monoline penalties are still better than the big banks, but even they're catching on to because it was just a massive movement of money from one bank to another, one lender to another, and mortgage brokers were making money on switching clients all over the place, and the banks weren't getting any more business because they'd lose 6 to one lender and get 6 from that lender, and paying out commissions to the mortgage broker on every one that they put in place there, and they don't have any more money on their books. So they caught on to that pretty quick. So, but it could be worth the penalty. So the first thing you'd want to do if you're not in a Smith maneuver type of ReAdvanceable mortgage is ask your bank what's the penalty to pay it out? So, and find out what that amount is, and then we can do the math from there.
It's a math problem for sure for that end of things.
Yeah,
it's a math problem. So now before we go on to other questions, and there's lots of questions, so I'm glad about that. Robinson, are there? I mean, we're all sort of sunshine and roses about the Smith maneuver and how great it is. Is there any downside that we need to know about? Are there any sort of pitfalls? Maybe not downside. Are there pitfalls or things that people need to know that you can tell us about?
Nothing.
Not a thing. Good man. Okay, passing on from that.
So the question I get quite often from people is, well, what happens, when the investments I buy lose money or I don't make as much as what I'm paying in interest? And that's not a Smith maneuver problem. That's an investment problem, or financial advisor problem, or something like that. So
there's an answer to that. I've seen it many times on the investing side of things. People, like, I would meet people, I'd go and travel, I'd sit down 2 hours explanation of what the Smith maneuver was when I was an investment advisor, and then effectively they'd say, thanks for the education, right? And off they'd go. And I heard many stories of people blowing themselves up because they started investing on their own. They thought they knew what to go in. They liked the sound of something hot that was, coming on the market, or their cousin's internet startup, or even they would go into somewhat reasonable investments, but then we hit a market bump and they freak out and they flush everything, rather than long-term stay on and hold, which is what this is. So the pitfalls here are the homeowner, really the investor. You have to have a long-term view here. You have to get professional, you don't have to, but I strongly advise you get professional advice on the investing side, not only because they understand investments and they know what has the best prospect of growing reasonably over time, but they can also be your counselor, your psychologist when markets get scary. They can also help you figure out if there's a major life change, divorce, death in the family, all these things that happen to people all the time that shake, rattle, and roll you. How do you deal with that when it comes to your finances? And if you don't have someone in your corner because you're investing by yourself in what you think is right, now, what do I do? How do I move this money around? How do I take care of my family? How do I do it appropriately? How do I make sure I don't pollute the deductibility of my investment loan? And this is what the SMCPs understand. So don't get in your own way. Use SMCP professionals for investing. Don't try to do your own taxes. Don't go into the bank and take the ReAdvanceable mortgage they're offering. It's not going to be the best one for you. So don't do it yourself. If you have been taking care of your personal finances to date, it's time to start enlisting professionals. So that's the biggest one right there, is on the investing side, getting it wrong, not doing it reasonably, and of sound mind, and sticking with it. Another risk is regulatory risk. Basically, the regulators, the government, they can make any change they want. They're the bosses, and we have to live within their rules. Shaune will be very familiar with in 2012, they implemented the 65% Heloc rule. In fact, all of your watchers are probably very familiar with that. You can borrow on a ReAdvanceable up to 80% loan to value on a P&I portion, but on the interest only Heloc portion, it'll only go 65% maximum for most lenders. So that affected the Smith maneuver, and it still does today. There's ways around it, but if you don't know how to get around it, you won't, right? So these changes that, and in the investing world, there was the whole thing several years ago with income trusts. They made changes to corporate class mutual funds as regards to taxation. So a lot of different things can come down the pipe, which will affect you to some degree, whether you're doing the Smith maneuver or not. We're dealing with taxation, the CRA, investing, mortgage rules, etc. They apply to all of us. But within the specifics of the Smith maneuver, you need to know how to deal with these if and when they arise. And so not having someone in your corner, you could end up getting it wrong.
Oh, the two risks: do it yourself is not a good idea. So people hear about this, they do it themselves, they get themselves in trouble. That's a risk, and that's on people who don't listen to us when we say get real knowledgeable professionals on your side. And on the regulatory risk side, it's one of those things that we have to know is out there, and we can't really do anything about that. So one we can do something about, the other one we just have to realize it's a possibility.
Yeah.
So let's move on to another question. Shirley says, how does this work when I use my ReAdvanceable Heloc as down payment to buy a property in a corporation?
Yeah, on the borrowing to invest side, again, you're going to want to confirm with an accountant. I'm not an accountant, but this should be fine. You're borrowing from your Heloc to invest in a business. That business owns property. You expect to generate income with that business, so you can deduct the interest. The issue that arises with this is when we're talking about implementing the cash flow dam with the rental property held in this corporation. And there's two different taxation regimes that we're discussing here. If you own that rental property as a proprietorship, that business and you are exactly the same in the eyes of the CRA. You're one and the same. But as regards having that rental property owned by a corporation, even though you own that corporation 100% by yourself, you're legally distinct, right? Barry, you'll be familiar with this. So you're two different legal entities. Even though you own 100% of that corporation. So now when we talk about taking money out of that corporation to apply as a prepayment against your mortgage, then reborrow to put back into that corporation, right? We're kind of talking about the cash flow dam here. There's different tax rules, and it gets much more complicated. And this is when you need the help of an accountant who can understand that. So the cash flow dam, as I've described it, really applies to proprietorships, so rental properties, but also home-based businesses. So if I have a business that's not incorporated, I'm earning income from that. I have expenses. I can run those revenues through my mortgage to service the expenses.
Okay. All right. Next up, is there any ReAdvanceable mortgage product in the market that allows the mixed use of personal and investing related expenses? Somebody wants to mix them all in the pot. That's what that sounds like to me.
I think we just said that if you put it all into the same pot, you could be in some hot water, so to speak, from the CRA. Because then how do you determine if you do pay back some interest, or how do you determine what's the deductible part and not the deductible part, right? So even if you're very disciplined, and you still got to show that paper trail of, I took money from this Heloc, I floated into my Smith Maneuver bank account. I used it to go buy Brex stock or whatever I might have done, and I get to write off the interest for that. So you got to keep a good paper trail, and it gets very messy if you pay back any of the interest or tracking it. That's my experience. So
yeah, another challenge and risk is not sticking to the plan and doing it wrong. I mean, it is possible. I go out, I get a mortgage, I've got my non-deductible debt, and I've got a line of credit which I can borrow from to invest. And I keep on doing that on a monthly basis. Things are great. However, my car blows up, and if I've got the space in my house, I can go and get another line to $30,000 to pay for that car. It's non-deductible debt, but it's separate from the deductible debt that you're increasing on a monthly basis. So it's all about tracking. It's all about being able to show what you borrowed and how much of that went to invest, and keeping a nice clean trail. And it's simple to do. Once you've had guidance from your SMCP on setting this up and what are my actions on a monthly basis, here they are. This is what you do. Do them on a monthly basis. Do this. If there is a problem, your car blows up and you need to pull $30K from your house, come back to me. Don't do it yourself. Come back to me, and I'll show you how we can get that $30K out so that you can go buy a consumption item, but keep the two types of debt separate.
The other question I get asked several times here in the last day is, well, why does it make sense to take my interest out of my or my principal out and back into my HELOCs? I'm just paying a whole lot more interest on my mortgage loan. And I said, you only pay interest if you actually invest it. So I think there's a misconception that you're paying this interest in your HELOC regardless of whether you've actually borrowed the money out of it. So
HELOC gives you money you can borrow.
yeah.
You don't pay unless you borrow. So
yeah, it's your piggy bank that you throw money into, and then you don't pay anything until you actually take the hammer to the bank and take it out. So you're not paying a higher interest in your HELOC, and the HELOC interest is right now it's usually about 2.95%. So typically when you borrow, you are hopefully investing in something that's going to make you more than what the cost of the HELOC is. Like you wouldn't go out and buy GICs at 1% out of your HELOC as an investment. So at least I wouldn't. So you want to. The whole secret of this is getting that delta interest rate between what your investment is making and what your interest is that you're writing off, and using the compounding interest, the eighth wonder of the world, as they called it, compound interest. So if you can make 5% on this money over 25 years, using the rule of 72, your money is going to be worth about 4 times more. So that's where the wealth creation comes from, is the compound interest that you're all these investments you're making.
So Shaune, because maybe some folks have heard of the rule of 72, that's a really good little rule to know. Just tell people what the rule of 72 is before we get on to the next question.
The rule of 72 is if you take 72 and divide it by the interest rate you're making, that'll tell you how many years that your money will double. So an easy example, if you're making 8% interest on an investment and discounting the fact that paying taxes on it, in 9 years you'll have twice as much money.
So 72 divided by your 8% interest rate equals 9 years to double your money.
If it's 6%, then it's going to take you 12 years to double.
And if it's 12%, it's going to take you
6 years.
6 years.
Yeah.
All right.
So
that's a great little rule to know.
Shaune, you mentioned the eighth wonder of the world. I make mention of that in my book here. True story. Someone once asked Albert Einstein what he thought was the eighth wonder of the world. He replied, compound growth. No, wait, the Smith maneuver. No, hold on. Compound growth. Final answer.
Final answer. So let's stop right now. Robinson, tell people about your book and where they can get it. And because I'm sure a lot of people want to get that book and read it from cover to cover a bunch of times. So give us that bit of information before we get on to the next question.
Sure. The way to reach out, there it is. The way to reach out, if you've got any questions or you're looking for, an SMCP in your area, whatever the case may be, the email address is info@smithman.net. And that's the book right there. Thank you, Shaune. That can be found at www.smithman.net. Have a good poke around. Yes, the book is for sale there. The Smithman calculator is on that site. There's a homeowner's course. There's lots more to learn. But if you're not too sure about this and you don't want to make this $25 investment in the book, I always tell people, go to the library and get the book out there. I'm not making my living by selling books. So I want people to educate themselves. If they don't want to invest in the book, go get it from the library.
Just get it.
Read it.
All right. Okay, cool.
Yeah.
All right. What's our next question? I'm not sure I understand this question.
I do.
So the reborrowing the LOC out, there'll be interest incurred. So how does this work exactly? Any detailed examples, please?
Okay. So here we go. We've got $400,000 mortgage, typical mortgage, and I'm making a $3,000 payment on that. Now I've got a ReAdvanceable mortgage. I've still got that same $400,000 non-deductible mortgage balance. I'm still making that same $3,000 monthly mortgage payment, but each and every month I'm reborrowing to invest from that line of credit. So while I'm paying $3,000 a month down here, I'm reborrowing on the line of credit, and my balance is going up. Well, there's interest that has to be serviced on that interest increasing line of credit balance. And that $3,000 a month is going here. So what's covering the interest on this increasing line of credit balance, the investment loan balance? And the answer lies in the increasing efficiency of the regular mortgage payment. The very first mortgage payment I make of $3,000, let's say $1,500 goes to non-deductible interest, that's gone, but $1,500 reduces principal on that mortgage. I borrow that $1,500 out. This is month one. I borrow that $1,500 out and I get it invested. Month two, my interest rate, that constant interest rate on my mortgage, is being calculated on a slightly lower balance. And so out of that same $3,000 mortgage payment, a little bit less goes to interest and a little bit more goes to reduce principal, say $3,003. Sorry, did I say $1,500 in my first example?
Yep.
Okay, so $1,503 is available. It goes down, available to reborrow. So $1,503 I've now got in my bank account. $1,500 goes out to service, to invest. $3 is left over in that account, and that's what the lender comes in to take for the interest on the first month's borrowing. Next month, $1,510 goes down. $1,510 reborrowed, $1,500 invested, leaves $10 in that account. The lender comes in and takes $10 for the first 2 months borrowing. So this is why no new money is required from my pocket to implement the Smith maneuver, even though I'm keeping my debt constant. I'm converting non-deductible to deductible debt. I've got a rising investment loan over here. It's the regular mortgage payment, the increasing efficiency of that payment, which takes care of the increasing interest expense. And another question people might have, if they're thinking deep enough about this, is, what happens if rates change and all of a sudden I'm paying more on the line of credit side than I am on the amortizing side? Well, if for a number of months or years I've been able to reinvest $1,500 a month constantly, and if the changes in rates are such that I have to adjust how much I'm investing each month, I can do so. So if the differential the spread in the rates goes against me, I can drop my investment from $1,500 that I've been doing for the past 3 years to $1,450 and keep that going on a constant basis to account for a change in the spread, but still no money out of pocket.
Right. All right. Wayne, let's get some more questions up here. And I think we still have a few more.
Yeah.
Sudesh Sharma says, the difference between a ReAdvanceable and a normal mortgage. It's a softball you're throwing up for Shaune to hit out of the park now. Come on.
Normal
See, no,
mortgage.
it's a serious question. Serious question.
Normal mortgage, your money is locked up in that equity vault of your home and you can't access it. So the only way you can get it out is to refinance somewhere down the road. Where your ReAdvanceable mortgage, you're getting a paycheck, so to speak, every month from your property to invest in whatever you want to do. Save it up for a house or buy stocks and bonds, whatever else. So that's the difference. So anybody who has, say, a couple of rental properties or something, they're building up equity. If it's $1,000 a month that they're paying down their principal every month and they got 4 or 5 properties, that's $5,000 that they can't get. So in a year, that's $60,000. So if you've got 5 properties and you want to buy another rental, you can either save it up from cash flow or your savings or your job, or you could have it come out of your rental properties and have it available for you to invest without having to go back to the bank after a year and say, okay, I got 12,000 in this property. Let's refinance that one. Let's refinance the second one and the third one. So now you have to go do 5 refinances to get $60,000. Whereas if you're set up with a Smith maneuver, that money would just flow into your bank account every month. So the difference between personal residence and rental property is that on your rental property, your interest is already tax deductible, right? Because of investing purposes. So the accelerators don't make sense on a rental property. You put the any accelerators, you make it on your personal residence to pay it down, because you already got deductible interest on your residence at your mortgage rate. So it doesn't make any sense to move it out and swap it for a higher interest rate, right? So the advantage on the rental property is you can access your principal pay down. So every month you can snag that money back.
Wow.
So if you did have excess cash, sock it against your personal residence till that's paid down.
All right. Next up, Ilona. Do I have to borrow every month, or can I accumulate for a 20% down payment and then borrow to invest into an investment property?
Yeah, you don't
Exactly. Yeah.
borrow each and every month. You can wait until you've saved up $50,000 or $75,000 of available credit in that line, because that limit will increase every month with your mortgage payment, but you're not pulling from it. So you're increasing your equity. But the question is, does it make sense to do that? And maybe personally it does, but from a financial perspective, if I'm waiting 3 years to get invested in a rental property because I'm waiting for that equity to build up, I'm missing out on 3 years of compound growth. I'm missing out on 3 years of tax deductions. I'm getting no refunds, therefore I'm unable to prepay my principal residence with the tax refund, which doesn't arrive. So there may be some personal comfort in, well, $1,000 a month, $1,200 a month. If I'm investing that, waiting to save up for a down payment, if I'm investing that, I have to get into the markets. I don't like the markets; they scare me. I don't like stocks, bonds, mutual funds. I don't want to do that. Well, if that's the case, if there's no investment other than real estate, maybe it doesn't make sense from a personal comfort level to just let that equity build up. But from a financial point of view, rarely will you find people who say, foregoing compound growth for 3 years on $1,000, $1,500 a month makes more sense than storing the equity. So it's a numbers question versus a personal comfort question.
Which brings up Patrick's question. It kind of fits with what we're just talking about. What would you put these $1,000 a month build-ups into?
Yeah, I used to be an investment advisor. When I sold my business in the middle of 2018, I hung up my license and I hung up giving advice on investing. I'm not licensed to do so. I'm very sensitive to giving advice on investing, considering what I did and the compliance regime and the regulators and all that. This is where you talk to an investment advisor. Interview different investment advisors. See how you get along with them. See what their philosophies are. Are they concerned with being transactional, or do they truly have, okay, tell me about yourself. Do you have a family that you're supporting? What are your goals? And they can direct you to the best investments for you. But again, the universe of what you can borrow to invest in and still generate those tax deductions is massive. There's many different types of investments out there. So it's a matter of picking what you're comfortable with, what you understand, and getting some guidance from someone you trust.
I saw a question in the chat there while I was scrolling. Someone asked if you could use it for your TFSA. So the answer is no. Interest on you can't borrow money and deduct interest if you're investing in your TFSA or RRSP. It's already tax advantaged, so you can't write off the interest for that. So
Good.
in my unaccountant opinion.
No,
All
that's
right. Barb says, why don't banks or even mortgage brokers tell you about ReAdvanceable Mortgages and the Smith Manoeuvre strategy as an option?
Shaune.
I do. So I can't speak for people who don't know about it. Long-time investor and understand access to cash. Could I diss on the banks and say a lot of banks, people aren't very educated in more than just punching some numbers into a computer and saying, here's the best product for the bank and take this. So
yeah, the banks have product to sell. The banks have their 200-year way of doing business. The banks are stuck in their way. The banks have representatives who are paid salary or commission or a mix, and they get paid on selling mortgages or selling investment products or whatever. There's no real incentive for the banks who have always done business the same way to reach out and offer or implement a financial strategy which isn't branded by their bank. I mean, there are some investment dealers out there who have taken the Smith Maneuver and sort of put their own shine on it and branded it. So, you know, the bankers do business the way they always have, and the bankers are going to always do business the way they always have. Now, there's a lot of changes in the digital world and that sort of thing. They're having to adapt, but you know, there's no real advantage for a mortgage specialist at RBC to promote some financial strategy which is going to require some additional effort on their part in education and handholding for a period of time once the client's set up, when all they can do is say, hey, here's a mortgage, this, we're going to put you in this one, it's an RBC, whatever it is. And they may not be pushing ReAdvanceable mortgages at the bank for the purposes of doing the Smith Maneuver, but they will offer ReAdvanceable mortgages and say, you know what you can do with this available credit? You can invest, you can do renovations, you can use it to consolidate, you can use it to, you know, they'll offer a whole bunch of things which aren't necessarily in many cases to the best advantage of their client. Because if they're saying, hey, you know, you can borrow each and every month from this line of credit, well, what are my options? Anything you want. And so now these unsuspecting Canadian homeowners, they see their credit rising, the limit rising each and every month. Fantastic. Now I can afford to make that Audi payment. Now I can afford, and the banks don't care because they've got you for life. The banks don't care whether you use that line of credit to invest or consume. They do not care because they've got the house as security. They don't care if you pull that available credit out, throw that cash in the fireplace. They've got the house as security. What they also have is a client for life. Non-deductible mortgage debt. It's getting paid down. That's bad. Oh, but what's good is that they're borrowing it back. We don't care what for. They've got you for life. And every mortgage lender feels the same way because your debt is their asset. But what we do with that debt is the difference between personal wealth creation or personal wealth destruction. So we have to use it wisely. And not all Canadian homeowners are educated to use it wisely.
So that explains why, although the Smith Maneuver has been around for quite a while, it's not really as well known as you think, and why there's still confusion. I think you just answered that question. But let's get on to another one. Facebook user says, is it possible to sell your house to yourself and get a ReAdvanceable mortgage on the buy? So
I'm wondering why you'd sell your house to yourself. You're just refinancing your house to get into a Smith Maneuver type mortgage. So I don't quite understand what the thought process behind this question.
Would it have something to do with selling the house in a corporation or something like that?
Well, it doesn't say that. So you know, if you sell it from a corporation to yourself, then you got capital gains. If you sell it from yourself to your corporation, there's no capital gains, but there's other ways to make your property, make your corporation a beneficial owner with a bare trust and stuff like that, that you don't have to do the sell it to yourself. So not really sure what the motive behind that question is. So
no, did we answer this one? Can you move the principal pay down to a TFSA and then invest?
You can, but then you're not going to be able to deduct the interest on that borrowing.
Yeah,
TFSA is already tax advantage, as Shaune said.
Yeah, and there's other things to do with your TFSA that you can have tax advantages on investing it through self-directed mortgages and stuff. So,
and there's our pal Denise MacPherson. Hello, Denise. If someone had previously paid off their mortgage and now has a Heloc with one of the big 5 banks and has been expensing the interest costs since the Heloc funded their investment acquisition, is there any benefit to a ReAdvanceable mortgage to pay off the Heloc?
Well, the question here is, firstly, you know, the Smith Maneuver is a debt conversion strategy for the principal residence. So here I've got a principal residence. I went and got a Heloc from one of the big 5s. I took out money. I went and invested it somewhere. So if one were to refinance into a ReAdvanceable, I don't see the benefit here. Firstly, do you want to pay that deductible debt down? or do you want to continue making interest-only payments? Now, if you refinance into a ReAdvanceable, it's still deductible. And Shaune, what do you think about this? Now you're making P&I payments, but you got a lower rate considering the spread on the amortizing is probably lower than the line of credit rate.
Yeah.
So,
well,
yeah,
to me, you're going backwards, because the whole concept of the Smith maneuver is to start with a fixed amount in your mortgage and zero in your line of credit, and one draws down and one increases, right? So Denise has paid down her mortgage, got her HELOC for hopefully as much as she could get out of the bank. So I don't see a benefit to going backwards and starting over again, because she's got a lot of interest. She pays off her deductible interest. It doesn't make sense to me.
No, but there's important. I know you got another question up there, but there's an important comment to make on that last question. If I've got a $300,000 fully tax deductible HELOC, and I'm paying prime plus a half, if I switch that into an amortizing loan with a ReAdvanceable mortgage, the rate on that amortizing portion is going to be lower than with current rates than the rate on that interest-only line of credit. However, I'm paying down that balance. And with deductible debt, do you necessarily want to pay down deductible debt? Probably not. But because it's a ReAdvanceable, I'm paying down that big balance with a lower rate. I'm reborrowing on the increasing line of credit, and both sides are now deductible because the original use of money hasn't changed.
Well, yeah, good point there. Yeah,
there's a name for this. Fraser, my dad, loved alliteration. He called it the Fraser finagle, and he came up with this after 08, 09, when the rates started doing wonky things. Interest-only line of credit used to be cheaper than the amortizing. Now it's the other way around. So Fraser says, well, how can we? Well, we can do. You've already got a ReAdvanceable mortgage because you've finished the conversion process for a lot of our clients. So we just did a balance transfer over to an amortizing, paying a lower rate, borrowing back on that line of credit, and effectively you're making interest-only payments, but there's a lower rate on the big balance.
It's not really a personal home mortgage anymore, because you're right. The purpose you're using it for is to pay off investment loans that you already got deductible interest. That's
the use of funds hasn't changed, so everything's still tax deductible.
Yeah. So I retract my previous comment. Delete that from the recording, Barry, please. Yeah.
Myself, I was just talking to Donna. So that's good, Shaune. Your apology is fully accepted. You can grovel a little bit. We'll all watch, and it'll all be fun. All right, well, folks, we run live at 5 for an hour. We're past an hour. We booked Robinson and Shaune for only an hour, but in looking at the chat, guess what? We've got, it looks to me like, a lot more questions to dig into. I'm just wondering whether we shouldn't let this percolate for a week or so and come back next week and carry on. I mean, can we do that?
I'm okay to stay on and answer questions if you're okay and Robinson's okay. I'm sure people would like to get some of their questions answered.
Okay. So. All right. Donna and I have another commitment, so we're going to have to remove ourselves at 6:15 in order to make our other commitment at 6:30. Okay. But let's keep going and see where we get to.
Yeah.
Next question. 2 questions regarding a mortgage-free property. Nice, a clear title property. Would it be advisable to obtain a HELOC and start off heavy with the investment, say $400,000 to $500,000, to create the largest tax deduction and investment value?
So this question has nothing to do with the Smith maneuver. It's a question on leveraged investing. It's straight leverage investing. So in any event, in my old ex-advisor cap on, I would say, I'm not going to give you an answer now. Come into my office, tell me who you are, tell me what you like investing in, what you don't, what's your house worth? Like, what's the LTV on that 500K? Is it 65? Is it more? Is it only a partial? You got a $3 million house? Lots of different variables here, but that's straight leverage investing. You don't have a mortgage, you're clear title, the Smith maneuver doesn't apply because there's no debt to convert.
Okay, so let's get on. It says there's 2 questions. I only see one in there. What's our next question? If a revenue property has large equity amount with available HELOC, would it be more effective to start Smith maneuver with maximum amount of HELOC to create tax advantage and investment amount?
Yeah, again, we're talking about the prime the pump accelerator here. We haven't talked about the accelerators, actually, really. Cash flow down, but basically, revenue property.
Yeah, a revenue property with large equity.
Okay, well, that depends if you still have that house, which is clear title, in which case I'm not really involved in this discussion because there's no mortgage, non-deductible debt on the principal residence. But if there is, you can pull from that rental property and you can invest it somewhere. The question again needs to be answered by someone who knows you, someone who's an investment professional, who can look at the actual taxation effect of making this move, what's suitable for the client. A lot of people will have access to equity and want to get it all invested, but they don't necessarily have the ability to, or the tolerance to carry it. So there's a lot of different factors. You got to sit down with a professional to discuss these types of questions.
Interesting. I see a pattern developing here, Robinson. When we teach our courses, when Donna and I teach our courses, we talk about a strategy and we delve into it in some detail. And I'm continually surprised by the number of questions and applications that people come up with, the number of scenarios that they think about that might, that just might be affected or be useful for a strategy. I'm seeing that here tonight. All right, next, if I am implementing the Smith maneuver for 15 years and my property value has increased by 300K, how do I access that?
Refinance.
So it's simple enough. If you've got a Smith maneuver property, you refinance and move the numbers up.
Yeah, that's the prime the pump that Robinson was just mentioning. You increase what's called your global limit, gives you more money to access.
So there's a way to access that equity increase that occurs over years. So that's good. That's a little extra. Well, I guess we're priming the pump. Yeah. Why come up with a new word? Next, is there a time in the life cycle of the Smith maneuver when you have paid off the mortgage and now it is fully held in the HELOC? And do you start paying down the HELOC, or is it now more profitable to keep it running once it is maximized? Okay, so we've done this.
Yeah, so this is when the conversion has been completed. Depending on the accelerators that you're able to apply, 25-year AM, maybe we're down to less than 10. Specifically if we're able to also implement the cash flow down. We've seen 7 years, right? So now let's say it's 10 years later. I've eliminated my non-deductible debt. I've got that HELOC fully deductible. What do I do now? Do I start paying down that HELOC? Maybe it's interest only, but I pay a bit more each month. And so my former mortgage payment, which I no longer have to make, maybe I apply all that and the balance of that HELOC comes down. The question to ask yourself is, over the past 10 years, while you're converting this mortgage to deductible debt, that's your primary goal. Now, do you want to start paying down that deductible debt? And if you're paying down deductible debt, it's very cheap money. If you're paying down deductible debt with $1,000 a month, you're necessarily not getting that $1,000 a month invested somewhere, which can earn you significantly more than 1.5% when we factor in tax deductibility in your marginal tax rate. So the question is, am I going to sleep better at night if I have less loan balance against my mortgage, regardless tax deductible or not? And maybe the other spouse, suffered through the maintain your whole debt process while you're in the conversion. And now, okay, we've done that. Let's start working on paying down that HELOC. Maybe that's the right thing to do for the family. But you have that salvage mortgage payment, which you no longer have to come up with. So you got more than enough to not only pay the interest on that HELOC, but also start paying it down if that's what you wish to do. But when you got that mortgage 10 years ago, you didn't know about the Smith maneuver, and you went into the bank and you promised your spouse, the banker, and God that I'm going to make a mortgage payment for 25 years. That's what you signed for. So now that you're out of it in 10, you have the freedom to use that former mortgage payment to do whatever you want. Yes, you can start paying down that HELOC, but maybe you only pay interest on that, and the difference you get invested each and every month, right? And that's what the Smithman calculator assumes with the strategy is that, you know what? I'm going to continue to come up with this monthly mortgage payment of $3,000 each and every month for 25 years because I'd already promised my spouse and everybody that I was going to pay that for 25 years of the day I got my mortgage. And now you're investing that difference between the former mortgage payment and the minimum payment on that HELOC each and every month, taking advantage of compound growth. You're not paying down deductible debt, which is really cheap, reducing your tax refunds. But again, it's a comfort thing, right?
Before we get on to the next question on screen, there's a couple in the chat that say, can Robinson tell us what are accelerators?
This is probably for another time, Barry. Happy to come back on, but we've got 5 of them. We've got the debt swap, cash flow diversion, the cash flow dam, the drip accelerator, and the prime the pump. We've talked about the cash flow dam, mentioned prime the pump. There's some others as well. And
somebody said, can we do next week on accelerators? It sounds like it's a whole other topic that we need to delve into, and we don't really have time to do it tonight. But what about, will this work if you buy a property with 5% versus 20% down?
It has to be 20% down or more. You can't be more than 80% loan to value on your property to do this. So it doesn't work when you buy a 5% down.
So what you could do though is when you're looking at buying your house and you don't have quite 20% equity, have a look elsewhere. Do you have existing investments? Could you sell those existing investments? Look at the taxation and apply that to increase your down payment to get you into a ReAdvanceable mortgage. Maybe it makes sense, maybe it doesn't, but get creative. Where can I find the money to get into a ReAdvanceable now?
Yeah, you do have to be at that 80%. So how you get there is decision you have to make.
Patrick says, can the interest be written off if the funds from the HELOC are used to pay for a whole life insurance policy? Ooh, good one, Patrick.
This one is for an investment advisor, but insurance agents are able to sell products which do qualify for deductibility of interest on borrowed money. As my understanding goes, it's only seg funds, which are a type of insurance / investment product. I don't believe so for whole life insurance.
So that's insurance is its own little subgroup. Insurance is complicated. So you got to delve into that one a little deeper, Patrick, with someone who knows more about insurance than I do, for sure. Next up, would there be any advantage to using more of my HELOC and putting down on the principal of my rental property?
No.
I guess we'd have to look at rates. What's the rate on the?
If you're borrowing from your, I think the question is if you're borrowing from your HELOC on your principal residence to pay down your rental property. If that's the question, then to me the answer is no.
Well, from a deductibility point of view, all you're doing is transferring deductible debt which is secured by one property to deductible debt which is secured by another. So the original use of that borrowed money hasn't changed, but the question is, does it make sense numbers wise to do that?
Yeah, I would say no, because your mortgage is likely going to be cheaper than your HELOC. So
all right, folks, at this point my producer tells me that we have to say goodnight to everybody. Shaune, I know you're ready to keep going, but I think we got to shut it off and figure out whether we're going to come back and dive into this a little more with a big chat on the accelerators, plus the other questions that we did not get answered. So I want to say thank you very much to Robinson Smith for coming on and doing a bang up presentation. It was great last night. It was even better tonight. So
all right, getting better.
Ecstatic. Yeah, you're improving. You're going to be a presenter one of these days, Robinson. I tell you, it's going to be great.
Good job, Barry.
If people
Shaune,
want to get hold of me and ask me questions, just Google my name, write it down because it's a weird spelling, and you'll find me on my mortgage website or something. You get my emails and my phone number and stuff from there if you're interested in talking further.
Shaun's in the group, so you can find him in there.
Yeah, happy to come back, Barry, and talk about the accelerators some other time, and maybe go through a quick demo of the Smithman calculator.
Oh, that'd be great. That would be great. Donna, what did you want me to say?
Not everybody's in the Creative Real Estate Education group, so send them over there.
Donna says I'm supposed to send everybody over to the Creative Real Estate Education group. When I said Shaun's in the group, that's what I meant. So for you folks who aren't watching, you can migrate over to the Creative Real Estate Education Group. You can find him there. Thank you for that kind offer to come back and discuss more things, Robinson, because I think there's more to discuss. All you folks get hold of Shaune if you want to get this moving along and you want some counseling and some coaching. He's a great guy to talk to. So on that note, hasta la vista, babies.